Hello, everyone, and welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you all this week from New York City. I've had some really good conversations with clients and others here in the New York City area. Good to stretch your thinking, change your perspective a little bit. What's interesting, though, is I feel like investors everywhere are dealing with a lot of the same questions we've been talking about on The Final Bar. What sort of upside potential is there left in this growth-led bull market phase? Is this initial retracement we've observed here in the last 3 or 4 sessions just the beginning of a deeper retracement with some of the leading growth stocks that we've been talking about, like NVIDIA and Supermicrocomputer and others? Is there a renewed sense of leadership or leadership rotation into things like energy at the top of the return list here today? A lot of questions. We'll get to as many answers as we can here. And we'll also do a special segment called Banking on Breadth, where we'll look in particular at some of the market breadth measures. Let's get to today's market recap and look at how the markets have evolved through the course of the day today. You know, as you're looking, the S&P 500 actually finishing slightly lower, about 0.2%. You can see the Dow slightly higher, about 0.1%. The NASDAQ composite really rolling over going into the close around 3 p.m. Eastern, sort of mid-range for the day after an initial sell-off out of the open, but some distribution going into the close. And that's interesting because that often is sort of an institutional crowd, usually doing a lot of the buying or selling in the last 30 minutes of trading. Sort of implies there's sort of a risk-off move going into the close, particularly with technology, which ended up at the bottom of the return list today. Mid caps and small caps both finished slightly higher. You can see volatility actually remaining lower. Not too much of a change, to be honest, from yesterday's close, but still below that 14 level. As we've talked about, VIX of 15 or higher, for me, would indicate sort of the end of this low volatility of an environment we've been experiencing here in recent months. Overall, really not seeing enough of a move above 15. As a matter of fact, I have an alert set for when the VIX spikes above 15. And to be honest with you, it's triggered a number of times here in the last week, but every time it's triggered soon after, usually by the end of that particular trading day, I feel like it's gone back below. So for now, I would say still a low volatility environment. Looking at the interest rate environment, you can see 10-year yields pushing higher along with the 5 and 30-year points as well. 10-year yield finished at just below 4.2%. The long bond yield right around 4.35. Bond prices moving lower with the TLT down about 0.5%. The dollar, no real change from Tuesday's close. The DBC triggered an alert that I had going on here. I'll try to jump over to that chart here in a moment if I remember to do so. Gold and silver prices both higher. Also energy prices. So crude oil, the USO was up over 2%. Copper prices up over 3%. Some of the biggest gainers are in that called non-ferrous metals is the group we classify. Things like Southern Copper and Freeport-McMoRan. We'll look at some of those charts, time permitting as well, both breaking out to new swing highs. Finally, cryptocurrencies, a lot of green here, although to mix, to be honest, but the two biggest ones that we track, Bitcoin finishing currently above 73,340. That's up almost 3% from yesterday's close. We made a new all-time high here in the last 24 hours yet again. First time pushing above 73,000. Certainly seems like the bull market is alive and well in crypto land. Ether prices, by the way, just getting above 4,000, which is pretty significant. It was above there yesterday. But did push back above here, currently just above, we'll call it 40.10. Looking at the 11 S&P sectors, it's worth noting that energy at the top of the list, the XLE was up 1.6%. Materials, number 2, up about 1%. In the financial sector, XLF, up 0.7%. On the downside, you have technology leading the way lower, down over 1%. NVIDIA got hit pretty good today. We'll look at that chart here in a moment for sure. Real estate down about 0.2%. Healthcare down about 0.4%. Looking at the market trend model, worth noting that even with today's slight distribution, overall the market trend conditions, thinking about those different timeframes I pay attention to, short-term, medium-term, long-term, no change. And I think that's worth remembering when we have a big down day, particularly like last Friday. I get a lot of questions, people saying, was that the top? Is that it? I feel like, to be honest with you, we spend way too much time trying to pinpoint a top and a bottom. I think there's a lot of money to be made and lost by focusing just on the bulk of the trends, and a lot of money to be lost trying to anticipate those things. before they happen. As a trend follower, I have to acknowledge that the trends for the most part are bullish across the board. Finishing off, looking at the magnificent group of stocks here. Again, less and less magnificent and certainly less homogenous. You've got quite a bit of diversity here. Worth noting Alphabet and Amazon. Now, neither of those are in the technology sector, of course. We have communication services and consumer discretionary represented here, but Alphabet, the biggest winner, up almost 1%. Amazon up about 2/3%. The rest of these were all lower. Note Tesla, which was down 4.5%. Apple and NVIDIA slightly more than 1% lower. Let's go to a daily chart of the S&P 500, just sort of check in on where things played out through the course of the trading day today. So overall, we're sort of staying above that newest trend line that I drew on yesterday's show. Again, I sort of drawing multiple trend lines with graduated, less steep slopes. So we had our first blue trend line here off of the October low, connecting that to the December low. We broke that here in mid-December, so I drew a secondary line to the green line using the January low, which actually lined up pretty well, but all of a sudden we've started to break that. So I've drawn another trend line using the October low and now the February and March lows. And for the last week or so, we've been bouncing off of that particular trend line support. I think no real change for me. I think this swing low, what we call a pivot point around 50-50, is an important level to watch. For now, as long as we remain above 50-50, I think this is a choppy, rotational sort of market phase. We break below 50-50, I think much higher likelihood that this is something more significant and certainly more dangerous. It is not lost on me, by the way, that the momentum continues to diverge. So we keep making higher highs, but we're doing so on weaker momentum. We're currently, attempting to make a new high. And yesterday we actually made a new 52-week closing high, a new all-time high. And the RSI didn't even get overbought. So you have this condition where the market's going higher on weaker momentum. And it's not just the S&P that can feature that. That's on the Qs and other charts as well, where you have stronger prices, weaker momentum. That's usually one of those signals of a potential topping pattern, to be honest with you. As I mentioned in the introduction, we're going to do a segment particularly focused on breadth indicators called Banking on Breadth. So I'm not going to go too much into breadth conditions before then, but we will dig into some of the breadth indicators and see how they've played out here. And long story short, they're still quite strong. They're actually still quite robust. I did want to focus just a little bit on some areas of the market. I was talking to my friend and fellow Stockcharts TV host Joe Rabel. We were actually talking about the commodity space earlier today, talking about just the strength that we're seeing in copper names. Of course, one of the biggest gainers. I think the top performing Dow industry group on our platform was this group called non-ferrous metals. Now I'm showing here not the metal stocks, but the commodity ETF. This is DBC, which is a broad commodity ETF. Now, it is very geared toward the energy space, so energy is the biggest weight, but it also represents some other charts within the commodity space. When you sort of mentally zoom out on this chart, I can't help but notice, so this is basically a retest of the summer 2023 low, right? At the end of May, sort of beginning of June, and really since March before that, we sort of hit support in the 21 to 2150 range. We actually tested that range a number of times. Then we have this nice break above the 200-day moving average. And I remember vividly in September, it certainly felt like this was a new bull market phase for commodities. And it was so interesting that was aligning with a pullback in stocks that, of course, made a major low at the in October of last year. But while commodities bounced off of an early October low, they rotated lower, testing or remaining below a descending 50-day moving average really through much of into this year as well. Now that's changed here, and you'll notice we retested that support around 2150, really ended up being around 2175 for the most part. Here over the last 3 months. But, just in the last week or so, maybe 2 weeks, we've really rotated back above the 50-day, now testing resistance. Now, previous rallies have stalled out before the 200-day. They stalled out pretty much exactly where we finished today, so around 2260. The DBC gets above 2275, which would take us back above the 200-day. That'll be the first time we've been above the 200-day since November of last year, basically since Thanksgiving. if we do break above there, I would see a return most likely to that September, October peak sort of range around 24.50. Now think about what crude oil prices do in that scenario. Think about what precious metals most likely do. Maybe those correlations between those two become very strong and you see further upside. It's so interesting because metals in general have started to perform quite well. Here's the chart of the GLD, which is the gold ETF. I'm highlighting resistance. I mean, the resistance level really from 2022 and 2023. Look how many times we tested that resistance around 190 to 192. Now breaking above there, and if you look, we've gotten the GLD back above 200. I believe that's the first time actually we've gone above the 200 level. So, does gold or in the form of the GLD deserve to be above 200? For now, the market is saying it certainly does. And we've had a bit of a pullback here yesterday, but today sort of bouncing off of that 200 level and pushing back to the upside. Now, certain gold stocks have done okay. Not all of them, though. This is Newmont Mining, really coming off of a low just below $30 a share. But Agnico, I want to say AEM. I'm trying to think of names that came up on my new swing highs list. I think AEM was one of it. Yeah, so just getting above this resistance from December. I was running a scan for stocks making new 3-month highs for my market misbehavior premium members earlier today. I noticed some of the gold miners. AEM is one of them. That's Agnico mine. So I'm grabbing my notebook and looking here because I sketched out a bunch of tickers. What was the other one? AU maybe? Here we go. AngloGold, even better chart, right? Breaking above 220, gapping above $20 a share, actually. And what I love about this particular chart as I was looking through it is, gaps in a lot of ways are unpredictable. It's hard to identify or anticipate that a stock is going to gap higher or lower. But what you can definitely do is track what happens after. After a big gap higher, one of two things tends to happen. Number one, you get, an immediate sell-off, right? We gap higher, and then anyone that bought back here is just so excited to be not in the red anymore that they close out. And if people sell that gap higher, then quickly the price will go lower. You'll often have like a shooting star candle or some sort of distributive pattern coming off of that gap, and then we immediately close the gap and drift lower. The opposite, the other option happened here where we gap higher, but then additional buyers came in. So stock hadn't been above 20 since back here in July of last year. We're finally back above there. Everyone here is now sitting on some sort of paper profit, but we're seeing additional buyers willing to push the price back higher. That's the sort of reaction post-gap that I think can be really compelling on a chart like AU. Let's look at some other names in this materials sector. And again, it struck me as I was looking for stocks making new 3-month highs. A number of things in the materials sector, actually, and particularly copper names. This is FCX, which is a mining stock, of course, sort of the mining names outside of gold names that you might know, like Newmont. FCX comes to mind. One of the larger names, actually, in the space, about a $62 billion market cap. We gapped higher today, and you can see we're actually closing just above that December high. We'll see if it has the sustainability, because the challenge right now is you have a lot of overhead resistance. That's a general sort of catch-all term that I have when we're rallying up to the upper end of a range. And what I mean is this, right? If you draw resistance levels not as hard and fast levels, but more like ranges, which I love doing. This is an Arthur Hill trick that he taught me long ago. I'm sort of highlighting the fact that the stock sort of hit resistance sort of in that 43 to 46 range. That really was here in January of 23. And then you can see these other highs in the first half of 23, and then also July of last year, December of last year, all right around this level. We're kind of right there. So we're getting to the point where the stock has topped out before. And while that is no guarantee that we're going to top out again, I think it is an important piece of information, because that's a level that has been a pretty effective resistance level going forward. I'm inclined to assume that a resistance level will hold until proven otherwise. And for now, interesting chart to watch. See if you can get above those December highs. By the way, you'll notice at the top of my screen, I got one of these alerts earlier today. I'm on Eastern time zone right now, so it's around 1:30 p.m. Eastern. But I can't tell you how helpful it is. And I was talking with Joe Rabel about this as well. We have a number of alerts, both of us set for things like the VIX, for commodities, for oil, for gold, for individual stocks, for benchmarks. Anytime there's a line in the sand, a level that I think is important, I always set an alert because immediately a top pops up in bright green at the top of the website. It sends me an email. It sends me a text to my phone. And wherever I'm at in the world, I get that alert and I know something actionable is happening. So if you're a Stockcharts member, which obviously you all should be, make sure you take advantage of the alert platform. It is fantastic. SCCO is Southern Copper. This is one of the biggest gainers in the list that I was looking at. It's around a 74 billion market cap. You can see this gapped higher, got about 10% to the upside. This is gapping above key resistance here in December. And if you look, we've really been consolidating for the last 3 months. And I think today's gap really gets us out of that range to the upside. So an impressive rally. Just to finish off our market recap, just want to remind you, Apple, still an important chart for sure. I mean, I think the two FANG stocks, maybe three of the FANG Magnificent Seven, whatever acronym we're going to give these guys next. So those leading mega cap growth names, three that I would be paying attention to. Number one, and maybe most important, is Apple. Apple has diverged quite a bit from leadership names like Meta and NVIDIA and others that have continued to push to the upside. Apple really has never broken above its summer 2023 high, and now we're at the lower end of this range. This is really just a big sideways pattern on the chart of Apple. Clear resistance around 197 to 200, clear support in 165 to 170. We are bouncing off of that level. That level, by the way, of support also happens to be a 38.2% retracement of the way back down from the January 23 low to the July 23 high. So this is a well-established support level. We're right there. If this level holds, I think this market has some upside potential, particularly the Qs and the SPY, because it tells you the growth trade is not dead, at least for now. Apple starts breaking down below 165. I think this has a lot further downside, and I think that could be one of those signs as we look back in months to come. We'll look back at those breakdowns in charts like Apple and Tesla as maybe a leading indicator. Tesla, by the way, breaking down through its final Fibonacci support level. So Apple's kind of up here at the 38.2% retracement. Tesla did a similar kind of thing from January 23 to July 23. 38.2% was tested back in August of last year, 61.8% tested in February, and now about 6 weeks later, we have confirmed a breakdown. I would suggest using Fibonacci retracements. That implies a round trip back to those January 23 lows, which is another, we'll call it 60, 70 points below current levels. The last one, of course, in this group would be NVIDIA. And of course, a lot of choppiness here with some of these mega cap leadership names. Bearish engulfing pattern on Friday was pretty significant. We're still sort of right within the middle of that range from Friday's bearish engulfing pattern. So either this thing pushes above 1,000, which I think would be incredibly bullish, or we break below that swing low around 850. One of those things is going to happen very soon. I think whichever way NVIDIA breaks, that is probably the direction of momentum for our benchmarks. Now, it doesn't mean we can't have some impressive breakouts elsewhere. That is not the stock I want. This is the one that I want. Williams-Sonoma. I found breakouts today in consumer discretionary, in healthcare, in industrials, in materials, in financials for sure, in consumer discretionary, and names like WSM are doing just fine, regardless of what the broader market is doing. Remember, it is always a good time to own good charts. That's our market recap here for today, Wednesday, March 13th. A couple quick announcements before we get to our next segment called Banking on Breadth. First off, I would encourage you to send your questions to us via email. What can we answer on our next mailbag show? Our email is thefinalbar@stockcharts.com. We're on X @finalbarsctv. And here on YouTube, of course, just drop a comment below the YouTube video that you're watching. We would love to hear from you. Hope to answer one of your questions in our next mailbag show, which should be Friday of this week. Also, to let you know, I hinted at this yesterday, got things all set up for you, and I would encourage you to sign up for our next free webcast that I'll be doing with market misbehavior called the Market Top Checklist. It's actually interesting. If you look at the times when I've done one of these webcasts before, it tends to be pretty close to a major market top, because when the conditions are so solid and you just start to see some signs of weakness, that's when I think it's important to reflect on what I consider the Market Top Checklist. 7 things that I'm looking for. Some leading indicators, some lagging indicators, more conformational, and a number of things to sort of have in front of you as you're navigating the markets here in March of 2024. Don't miss this free event coming up next Tuesday, March 19th at 1 p.m. Eastern. You can sign up at marketmisbehavior.com/checklist. Hope you're able to join me for that event next Tuesday. Let's continue on with today's show with the segment called Banking on Breadth. What I wanted to do is just focus on breadth indicators. This is a popular segment. As you know, if you watch this show for any amount of time, we love breadth indicators because, I was taught most important is to look at the chart of the S&P 500, which I do many times every day, but certainly it's one of the first charts I look at every morning as part of my morning coffee routine. Very quickly, though, I get past measures of price and into measures of breadth because I learned a long time ago looking at the participation or the performance of the different index members can be so valuable. So here we're actually going to break down some of the breadth indicators that I follow on my Mindful Investor live chart list. By the way, if you want to access this list of charts, and you're new to the Final Bar, and welcome if you are, go to our main page, click on the Articles tab at the top of our website. You want to go to my blog, which is called The Mindful Investor, and at the very top, you will see this little gray button that says Live Chart List, and if you click on that, you'll get to a live version of these charts. If you're a Stockcharts member, again, which you all should be, of course, you can copy these charts directly to your own login. You can edit them, share them, do whatever you like with them. But no matter what, you're welcome to see the current levels at that hyperlink. When we're looking at pure breadth indicators, and the way that I would describe these is looking at the advanced decline lines on different, what I call cap tiers, you'll see overall things are quite constructive unless you're looking at small caps. That's been a well-defined or well-discussed topic on the show here, the lack of participation of small caps. I think I learned a long time ago in recent market history. I was taught, a number of years ago when I was learning all of this, small caps were a great leading indicator, a great risk on, risk off indicator. When the markets are doing well, small caps tend to outperform. When the markets are doing worse, small caps tend to underperform. I think that made sense when the market was a little different, particularly our benchmarks, right? The S&P and the NASDAQ 100 are very dominated by growth, and it was a lot less so in the early 2000s as I was learning the technical toolkit for the first time. So for now, if the question is, can the market rally without small caps participating? The answer is absolutely. And I think we've got plenty of examples in recent market history where that has absolutely been the case. Now, if you look at the New York Stock Exchange, which is a pretty broad universe, the advanced decline line has made a new 52-week high here in the last week. Same can be said for the large cap advanced decline line and the mid cap advanced decline line. The only one that is not is the small cap AD line, which actually has not even gotten above the July high of last year. The December rally stalled out before we reached that level, and we've been making lower highs since. So certainly it has not been small over large. I'm very curious if we get sort of a catch-up trade where small caps, which have been underperforming, start to catch up to large and mid caps. The McClellan oscillator remains in a healthy bull market phase. This is actually not updated yet for today's close, but I didn't see enough deterioration to suggest that this is going to do anything but remain above that zero line. And this green shaded area basically indicates where the McClellan oscillator has remained above zero. This is a short-term breadth indicator. So that previous one is looking more at long-term trends in breadth. This is looking more at short-term breadth rotation and seeing if we get a break above or below the zero line. For now, it certainly seems pretty constructive with the McClellan oscillator remaining above zero. So even the short-term breadth is actually quite strong. Even with the uncertainty on NVIDIA and those leading names, what if they pull back? What does that mean? The breadth, I think, remains quite strong, and that's a theme we're going to talk about through this segment. And what that helps me think is, even if the S&P and the NASDAQ start to correct a little bit or have a bit of a pullback, that doesn't mean that a lot of individual names, we've highlighted some just today in our market recap, that are actually making new 52-week highs just fine. So there are plenty of good charts out there. It's just not in the growthy sectors that you would expect would be doing well if the bull market phase is in good shape. This is looking at new 52-week highs and new 52-week lows on the New York Stock Exchange, and then at the bottom in the S&P 500. Again, we don't have today's closing bell data registered just yet, but overall through Tuesday's close, you can see a healthy number of new 52-week highs. The bear case for here, certainly the pullback case would be a lot less green, and you start to see some red. And a lot less green would be very common with a bull market top, right? You sort of have a bunch of green as we're making new 52-week highs. We're in a bit of a pullback phase, like this sideways correction we saw in early January, or even here in the August, after the August peak of last year, you saw the green all of a sudden evaporate, and then very soon after, you saw more and more red. That's because a lot of stocks right now are well above their 52-week lows, but if you start to see more and more red, that would tell you it's more of a protracted decline or a pullback phase. So still, again, quite bullish. We finished today above 80% of the S&P 500 members above their 200-day moving average. And, the basic way that I use that indicator, I have a horizontal line in pink right at 50%. We're above 50%. That's bullish. We're below 50%. That is not bullish. We are above 50% and actually well above. And before you think that that's, the highest that we've been in the last couple years, is that a sell signal? It isn't really, and I'll show you a chart a little bit that confirms that. One of our 3 and 3 charts actually looks at a little deeper history on the percent of stocks above their 200-day moving average. Percent above their 50-day, right around 80%. Now, I've highlighted in purple or in pink here when we've gotten above 90%. I actually have found that to be a pretty reliable indicator of a short-term pullback, but it didn't work in January. And we had a couple breadth indicators like this one, percent of stocks above their 50-day, the bullish percent index on the S&P 500, both of which gave short-term sell signals, but they did not play out particularly well. The markets actually remained quite strong. And again, I think that is because of the nature of the leadership, sort of the AI trade, a relatively small number of huge names doing quite well. That was enough to keep the market benchmark strong, even though a lot of names were actually breaking below their 50-day. Now you can see that's changing, and all those swing highs that I mentioned in sectors like healthcare and financials and industrials and materials really aren't reflected to as much of a degree in the price of the S&P, but are certainly reflected in improvements in breadth, and that's where I think we're at here. The bullish percent index on the S&P 500 is back above 70%, finished the day here around 73%. I think that is updated for Wednesday's close here, so overall remaining quite strong. We'll let you know, and we'll keep an eye on when that breaks down below 70%. That has often been a good indicator. You can see here we're around 58% of the NASDAQ 100, so only 58 of those 100 leading growth names are above are in a bullish phase still with their point and figure chart. So there's your performance gap right now between growth and everything else, or mega cap growth and everything else. S&P 500, 73% bullish. NASDAQ 100, 57% bullish. That is a big discrepancy, and look at how this trend has continued lower. This is part of that leadership rotation that I think we've been talking about. This is that alert I mentioned. I keep turning the alert back on. It keeps triggering, and then the immediate next day, it goes right back below 15. I think we get above 15 and stay there on the VIX. I think that would be a really negative sign for stocks. And by the way, that is not a breadth indicator. It's actually more of a sentiment indicator. But I did want to mention it because the VIX overall has remained sort of in that low volatility environment. So overall, when you think about breadth conditions, I think the most important chart is this first one to sum up this segment, banking on breadth. Look for charts that are working and look for charts that are going up. And some of the charts that are going up in a consistent way are the advanced decline lines on our different cap tiers. And when large cap AD line, the mid cap AD line, and the NYSE's AD line continues to go higher, continues to make new 52-week highs, that is not bearish. And I've learned to not be too bearish when these AD lines are going up. Even if our benchmarks are going down, it still tells you that if these breadth lines are going up, that tells you that there are opportunities out there. There are Williams-Sonoma, FCX types of charts, Southern Copper, and others that we highlighted, insurance companies, some banks, many, many others that are breaking out. Use the scan engine to find out which names are causing these breadth conditions to remain very strong. Those are your leadership names in any environment. All right, folks, let's wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of the market environment. Here is chart number 1. I mentioned the VIX at the end of my segment, banking on breadth. I just want to point out the fact that there is a bit of a divergence right now between the S&P 500 in the top panel and the VIX in the bottom panel. Now, I'm plotting the VIX upside down, which is something I like to do because lower VIX tends to line up with lower stocks. Higher VIX, meaning it's going lower on this chart, tends to coincide with weaker stocks, right? So higher volatility on weaker stock performance. When the stock market is in an uptrend, you have volatility declining and the VIX getting much, much lower. So I plot this upside down so that the contours of these two data series look the same, and you can see that pretty consistent inverse relationship very clearly if you flip the chart of the VIX upside down. By the way that you do this, if you're new to the Stockcharts platform, you just want to put a minus sign before that second ticker. So use an indicator called price. Here I have minus $VIX, And you can see that that's the way of indicating, of inverting the scale. It's a common stock charts trick, but it's a great way I have found to compare two series that tend to have an inverse relationship. Just invert one of them, and you can look at the two of them together. Now, look at how this relationship has maybe diverged a little bit. We're actually seeing the market go higher on higher volatility. Now, that usually means it's not a good sign for stocks. When you have an elevation in volatility, usually does not mean the market's going higher. It usually means elevated fear, elevated uncertainty, and that usually means weaker stocks. So that divergence most likely is going to right itself very soon. Chart number 2, the percent of stocks above their 200-day moving average. And I'm going back for the last 20 years, so I go back to 2004, but I'm really paying attention to post-09, right? Sort of post-financial crisis. I think you have a good, fairly consistent bull market phase, at least a secular bull market that is, I think, undoubtedly still in play here. And what I want to notice is we're currently just above 80%. Now, I have this red dashed line indicating previous times we've been at 80%. And what you will notice is that while there may be times we have a brief pullback after we hit 80% of stocks above their 200-day moving average, more often than not, it tends to be further upside. And noticeably, here in 2013 and 2014, we spent most of the time above 80% because it was this low volatility, consistent uptrend. So I would be wary about saying when this indicator gets to 80%, you need to start selling, because in a sustained bull market phase, that just does not work. Now, one thing that does work, and one of the things that you can use to differentiate these short-term kind of pullback plays versus sort of the long-term playbacks. In sort of 2016 and 17, in 2013 and 14, look at the pullbacks that you saw, right? So you got up to around 80%. We pull back, but the indicator never got below 50%. And that is one of the ways that I use this chart, particularly when we do get a pullback, which obviously we've not had yet. But if we do, I would look to see if it holds 50%, because if it does, that usually means conditions are just not getting that bad. Most stocks are staying above their 200-day moving average. Things are hanging in there okay. We break below 50%, and you can see why I use this indicator. Look at all these times where we get below 50%. That usually is the beginning of a deeper and more protracted decline, more of a deeper sort of a pullback phase. So, for now, I don't see this necessarily as a negative signal. I think getting down below 50% in a pullback is a much more reliable indicator. I would also note, look at all the times in the last 15, 20 years when this indicator has gotten below 20% and then pushed back above it. Those are literally your major bottoms going back for the last 25 years. So I will tell you that if and when we do get a significant decline, it will happen again at some point. I don't think today, but at some point, maybe in the near or distant future, look to see if we do get a big sell-off. Just wait to see when we get below 20%. Be a buyer when we pop above that 20% level. That tells you everything's going down, and now some things are starting to improve a little bit. That is usually a pretty good bottoming sign. Finally, we have a weekly chart of Norfolk and Southern, NSC. This is a railroad stock. Railroads have been in a pretty good shape. A lot of groups within industrials, to be honest with you. Heavy construction, trucking names. Many others have done quite well. Charts like CAT stand out to me as I'm thinking heavy machinery, as I'm thinking of constructive names. Everything but airlines and Boeing probably doing okay at the moment within this sector. But look at the weekly chart of Norfolk and Southern. I just want to highlight, because NSC has been in a clear distribution phase, right? After we hit an all-time high at the end of 2021, look at this decline in 22 that really continued in 2023. Now, what marked this bearish phase on the weekly chart? Well, a clear pattern of lower highs and lower lows. That was certainly meaningful until we broke. We broke above that trend line in November of last year. We pulled back and tested that trend line before breaking above the 150-week moving average. That would be another thing I would tell you. In a bear market phase, we often get below the 200-day, and in a deep retracted phase, we'll get below the 150-week moving average. You can see we tested it a number of times, but then finally got above it. Look at the momentum. The RSI in a bull market phase tends to become overbought, rarely gets below 40. In a bearish phase, the RSI will get down toward 30 and will rarely get above 60. So when we finally get an RSI above 60 at the end of last year, that tells you we are rotating. So finding that rotation from a distribution phase to more of an accumulation phase, recognizing that the strength in the daily chart really is shown on the weekly chart as a larger rotation. I think that is a really effective way to use multiple timeframes on the Stockcharts platform. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close. Thanks for hanging with us this week as we do the show remotely from New York. For Stockcharts and Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.